In 3, 2, 1, go.
Hola, muy buenos días. Les habla Carles Gaju, gerente de distribución institucional. En nombre de BICE Inversiones les doy la bienvenida a nuestro webinar de Stepstone Secundarios Fondo 5. Hoy nos acompaña Mark Maruszewski, partner y co-head de la estrategia de secundarios de Stepstone, y como siempre también Shannon Bolton, managing director de Stepstone. El objetivo del webinar será presentarle la estrategia de inversiones de Stepstone, su track record y sus proyecciones en el marco de las oportunidades y del mercado secundario. Como siempre también, al final de la presentación tendremos tiempo para conversar con Mark, y así que nos pueden ir escribiendo sus preguntas en el chat y después las iremos agrupando para que José Antonio las pueda hacer al final de la presentación. Con esto, les pedimos disculpas por el atraso. Shannon, te doy la bienvenida y muchas gracias por estar aquí hoy con nosotros.
Shannon, you're muted.
Estás en
Thank you. Thank you very much. Hi, everyone. Thank you for your time. Thank you for joining us for our second webinar to discuss our fifth secondary strategy. We are looking to raise about $3.5 billion for our fifth fund, which will close next year. This will be a 2022 vintage, and we are looking to do our first close in Q1 of 2022. Mark Maruszewski will be joining us in during this presentation today. As you are all aware, he is the co-head of the strategy and a partner at Stepstone. He has been investing into the secondary market alongside his partner and other co-head Tom Bradley for well over 20 years. It's important to note the history and experience of that team. We're really excited with our we're excited to present our strategy to you, and we are thrilled at the returns that the team has generated. So with that, Mark, I'll leave it to you. Thank you all. As Carles had said, please feel free to write any questions that you have to us in the chat, and we will answer those for you. Thank you again.
Great, thank you, Shannon. Can you hear me okay? Shannon?
Perfect.
Yes, we hear you. Thank you.
Okay, I'm getting feedback on my screen. Can people see the presentation? Because I can't actually see it on my end. My screen is glitching. Can you see the presentation?
I do see it.
Okay, I think I need 20 seconds to disconnect and reconnect. I've got a technical issue, but I'll be back in 20 seconds if that's okay.
Yep.
Apologies.
Okay.
No problem. With that, Diego, do you want to go to the firm slide and I can just quickly discuss? There we go. So for those of you who don't know Stepstone, this is just a brief snapshot of our group. Our numbers have increased in the last few months due to a recent transaction with Greenspring. Mark, you are there. Do you want to go ahead and take over? We're just
Sure.
I literally just started talking about the firm. Go ahead.
Well, thank you very much for the introductions, and thank you very much for your time today. My name is Mark Maruszewski. I'm one of the co-heads of the secondaries practice at Stepstone. And as Shannon was sharing with you, platform plays a meaningful role in our success. So as Shannon mentioned, you know, I've been in the secondaries industry for approximately 22 years now. And our entire strategy was born out of the belief that 10, 15 years ago, there was a lot of capital chasing transactions, typically through brokered processes. Secondary buyers were raising multi-billion-dollar funds, and what happened after about a decade of this, pricing got very high. The portfolio construction between one secondary manager to another was pretty undifferentiated, and what happened was secondary managers were generally producing beta-like returns. So if you think about the average secondary fund 10 or 15 years ago, $5 or $10 billion of capital, buying 50 to 100 funds at a time, assembling a portfolio of thousands, 5,000 to 7,000 underlying partnerships on behalf of their investors. It's very difficult given those dynamics, high pricing through brokered processes and a multi-thousand underlying portfolio construction, very difficult to outperform as a secondary manager. So you saw, you know, in the early 2000s, a lot of clustering of returns. There wasn't a lot of distinguishment between any one secondary manager from a return perspective or a portfolio construction perspective. And we just thought that there's probably a better way to do this. And we believe quite firmly that if you can focus only on the highest quality funds that are available for purchase in the marketplace, and if you can get those portfolios or funds at a above market discount, then you should be able to not only create a portfolio that's very distinguished from your competitors, but also has the opportunity to outperform by virtue of the fact that you're achieving a larger than market discount and you've aligned yourself through portfolio construction of better performing underlying funds. And those managers and underlying assets have the ability to generate significant alpha on behalf of investors. So that's what we did some 12 or 13 years ago by joining Stepstone. Stepstone, as Shannon started to share with you, was one of the largest private markets, actually is the largest private markets solutions provider in the world. So we have close to $500 billion of capital that we oversee, of which we have approximately $110 billion of discretionary asset management. And importantly, that number in the top right, 50 billion, is the amount of commitments that we're making on an annual basis. So every GP in the marketplace wants to be in front of that $50 billion wave of capital. And they care very much whether we're making primary, secondary, or co-investment investments alongside of them. And so that really is the magic which frankly distinguishes us from our competitors. Because we're so large and well-informed and influential in the marketplace, these managers in the marketplace are pushing us proprietary deals. And so if you are, pursuing investment opportunities through a proprietary pipeline as opposed to the auction segment of the market with fewer bidders looking at any one opportunity, you can typically find arbitrage, information arbitrage opportunities, and there's less pricing pressure. So even though you're buying higher quality funds, you can typically get them at a much larger discount, and I'll show you some data later in the presentation. But Stepstone is a private market specialist. We have very large activities in private equity, real estate, infrastructure, and private debt. So anything that comes to the secondaries market, we have specialized teams within the firm to diligence and recommend to the secondaries team those opportunities. We manage all of our capital in multiple ways. Some clients hire us for separately managed accounts. SA5 is one of our focused commingled funds that invests alongside of our very large separately managed accounts, but we also provide advisory work, right? So a large portion of that $50 billion is just advisory work where we're recommending to a client which small market, mid-market, European distress, or Asia growth equity fund to invest in. So our database tends to be extremely large and it's market leading. Typically our clients indicate to us that our database is better than any other database that they've seen in the marketplace. And that's the tool that both my colleagues internally, as well as all of our clients, utilize to inform themselves and educate themselves about the best opportunities in the marketplace. We also do all the back office portfolio analytics and reporting. So we are sitting in this very favorable position with more and better information, a proprietary pipeline of opportunities on the secondary side and on the co-investment side, where GPs are pushing us opportunities uniquely and not through an auction process. Next slide, please. So our footprint is global. We have, offices in every segment of the market where there's active private markets, and all of these offices are led by partners and individuals who've grown up in those geographies and are very, very well connected to the underlying managers in their marketplace. So if we're looking at a European distress fund or an Asia growth equity fund or a North American lower mid-market fund, we have folks internally that know these managers and the underlying economic systems and structures very, very well, and are very strong at underwriting these opportunities so that we know precisely what the risk return opportunity is that we are pursuing in any one case. Next slide. So I won't spend a lot of time on this. On the primary side, we've deployed about $45 billion in primary commitments per year. That's across over 215 managers globally. So if you think about doing that on an annual basis, the database and knowledge across the team that we have is quite deep and quite wide. We sit on over 250 advisory boards, and we're taking, as a firm, it's not just the managers that we invest in, but we're taking over 4,000 GP meetings across the platform each year. All of this information, falls into our database, which is called SPI, Stepstone Private Markets Intelligence. So it makes us very effective at, when we see a portfolio of 50 funds that come to market for purchase, it makes us very effective at identifying the 1, 2, or 3 funds that are most attractive from that larger portfolio. We're a significant co-investor as well. We've committed over $12.5 billion over the years to over almost 200 different co-investment opportunities, and we typically sit on the board of the larger investments on the co-investment side. So if you think about whether or not you do a primary fund commitment or whether or not you do a co-investment, it kind of doesn't matter. It's always better if you are in that portfolio company or in that fund. But we typically have, for instance, on the co-investment side, even if we pass on a particular co-investment and we see that same co-investment come through the secondary market 3 years later, we can actually triangulate the expected, revenue and cash flows of that business 3 years ago to what they've achieved today, and make a very thoughtful decision as to whether or not we're willing to pay for those cash flows. So it gives us a very strong sense of who are the better performing fund managers, which are the better performing underlying portfolio companies. And it's all very synergistic to our secondary business, right? Secondaries is like any other industry. People take care of their best customers, and we tend to be a best customer from a primary capital and a co-investment capital perspective, and therefore not only get proprietary deal flow, but we have red phone access to anybody that we want to speak to at any manager to talk about any underlying portfolio company. So it makes us very different than the competitors in our space. Next slide, Shannon. Actually, let's go to slide 11 if we could. Just one word on team, since we skipped over that team. We have a 29-person team, and there's been very little to no turnover on that team since inception. People very much enjoy working at Stepstone. We've grown quite a bit over the last 12, 13 years, but people like being part of something very successful. And so Shannon and I are frankly privileged to work with very smart, self-motivated individuals, and everybody is having quite a good time at Stepstone these days, and we hope that will continue. The top part of this slide does talk about the platform again. I talked about the primary capital and the diligence advantages of being so well informed of all the primary opportunities over the years and all the fund positions that all of our clients have, and being in a position to get quarterly reports on thousands and thousands of underlying funds. It really puts you in this advantaged position. But internally, we've also organized ourselves into 10 different specialized sector teams or geographic teams. So if you are on the investment team within Stepstone, you're assigned a particular sector or a particular geography. It might be in North America, it might be small market buyouts. And you and 8 or 10 other people, that's all you do is look at small market buyout managers. Or if you're on the European team, you only look at European managers, and then within that, you may only look at distressed managers or turnaround shops. So you know, when we approach a secondary opportunity, we have these 10 different sector teams that we can actually go to and say, hey, have you heard of this small market manager? We don't really know them that well. And these individuals have been tracking them for decades. And so they say, yeah, that's a great manager. It's, a top pick of Stepstone's. We had 4 clients go into that manager on their fund 3. Their performance is top decile. And then as a secondary team member, you know what you're dealing with and you know how aggressively to go after that particular portfolio. Of course, the feedback could be quite negative, which is also beneficial, right? It helps you sift through the opportunities and be able to only focus on the very highest quality opportunities in the marketplace. On the information side, I did talk about our database, but when people think about information advantages, it's not really just your database. It's also how many advisory boards seats you're on. It's also how many professionals you have. How close are they to the managers in their particular geography? How well do they know the underlying funds and the underlying portfolio companies? How close are they to the GP? Do they have kind of red phone access to the people that are going to be very helpful to us when it comes to diligencing an opportunity? And so when you think about Stepstone, I would encourage you to think about the information advantage as not being so simplistic as just a database. It's people, it's geography, it's relationships, it's the amount of primary capital, it's the amount of advisory boards. And when you put all those things together, we really feel as though there's nobody else in the secondaries world. We don't have a monopoly on all these things, but our world is a world of degrees. Our database is larger. We sit on more advisory boards. We invest more co-investment capital. We invest more primary capital. Our clients are in more funds. So the degrees to which we are, ahead of our competitors in all of these categories is material. And so on the margin, we're going to see more unique opportunities, know more about the underlying portfolio companies, have better access to the underlying managers to get the real information on what's going on within a particular fund or within a particular portfolio company. On the bottom half of this page just really talks about, what we emphasize from a secondary strategy perspective, okay? I've talked a little bit about quality and vetting the quality of everything that we purchase. So if you look at our last fund, 84% of everything that we bought in our most recent secondary fund was either a first or second quartile fund. Of course, the holy grail in private equity in general is to expose your portfolio to the first and second quartile managers as much as you possibly can. That's very difficult to do on a primary basis. In fact, it's hard to do on a secondary basis too, because it's not about where a particular manager is performing right now. It's where the manager will ultimately perform. It's easier to do it on a secondary basis because you've got 3 to 5 years of information about the underlying fund and the underlying portfolio companies, but it's still quite difficult. But our portfolios since inception are heavily concentrated in first and second quartile managers, which is a great thing. But when you combine being largely in the first and second quartile fund managers with the fact that we've achieved about a 20% discount since inception on everything that we've purchased, it's a magnifying effect on being in the first and second quartile, and part of the reasons why our returns are so good. So being in the first and second quartile is very important to outperform, but if you can get that exposure at a 20% discount, it's very powerful. In the middle there, it talks about building alpha-oriented portfolios. Remember, I mentioned that most or many of our secondary competitors will put 5,000 to 7,000 underlying fund positions in each one of their portfolios. We will typically put 70 to 100 funds in each one of our secondary portfolios. So they are buying beta, right? If you're buying 7,000 funds, unfortunately, that's beta. That's a cross section of the entire marketplace. But if you're buying 70 to 100 funds and you're concentrating them into first and second quartile, you're certainly diversified enough, but you're exposed to the better managers. And that exposure allows you the potential to outperform as an investor in our vehicles. 95% of everything that we've done was the pursuit of either a single fund or 2 managers managing, 2 or 3 funds. So the vast majority of everything that we do is 1 or 2 managers. We don't go out typically and buy 50 funds at a time and buy beta. We're happy to buy beta if it's a situation where the portfolio of funds that is available are all very high quality and we can price it to an alpha return. That's a fantastic opportunity. We have bought multi-fund portfolios, but we'll only do it when the quality is there and when we can close it at a price that is going to generate alpha, not beta, for our underlying investors. Over 70% of everything that we buy within our portfolios has traditionally been small and mid-market buyout, as well as growth equity. So again, those segments of the private markets that typically outperform. Performance on the large cap side of private equity, typically has lower returns, but those names are also very much frequented by all buyers in the marketplace. But if you know who all the small and mid cap managers are and who the outperformers are in the small, mid-market and growth equity, you can actually tilt your portfolio to those higher returning, very high quality emerging managers, which has been very successful for us. One point I would like to make about auctions, we think auctions are evil, right? Any situation where you are put into a situation and you have to beat, 49 or 99 other bidders, is a difficult situation. Typically, the winner of a portfolio where there are 49 or 99 other bidders is someone that is accepting a lower return and or making more aggressive assumptions on the underlying portfolio. And so we typically avoid auctions at any chance that we can. We just think it's a means by which to destroy value add for our underlying investors, and have typically pursued most of the things that we purchased through our proprietary network. The last thing I'll say is on leverage. Most secondary funds in the marketplace use leverage. We do not use leverage as part of our strategy. The alpha, most managers that are using leverage on the secondary side are doing that because they're buying portfolios at a very low rate of return. They need to bridge their way to a higher rate of return in order to raise additional capital when they come back to market. And so they use financial engineering to bridge from an unsatisfactory return to a satisfactory return. But with leverage, there's more volatility, there's more risk of potential variability from quarter to quarter. And of course, there's the opportunity for upside if you're in a secular expanding capital markets environment, but there's a meaningful exposure to potential downside if markets contract. So you should think about our portfolio construction as focused on first and second quartile, maximizing discount, not needing to lever our funds because we're typically getting large discounts on high quality product. And therefore, because we don't use leverage, we have less volatility from quarter to quarter in terms of our marks, and therefore it's lower risk. On the left-hand side, you can see the returns, 20% net to our investors since inception, and a 1.8x net cash multiple. Next slide. So there's a big trend in the marketplace today, which is called GP-led transactions. So for the last, 15 plus years, most supply in our marketplace came from limited partners selling. And a lot of that supply came through the auction market. So you would have a pension fund or an endowment or a wealthy family selling their portfolio, calling a broker, and bringing those limited partnership stakes to marketplace. Sometimes GPs would get involved when they wanted to close the process down and push those opportunities to 1 or 2 or 3 of their favorite limited partners. We typically get those calls because we are the largest private markets investor in the world these days. So we still get that type of GP directed deal flow. But what's happened in the last 5 to 7 years is that the GP led transaction volume in our marketplace, GPs are now they are now very focused on retaining their best portfolio companies. But in order to retain their best portfolio companies, but at the same time give liquidity to their prior investors in their funds, they need to utilize the secondaries market. So the GPs have, entered the market and are very active selling strips of their portfolio to manage up the distributions in their funds, or selling a handful of portfolio companies because it's the time in the life cycle of the prior fund that owns those individual portfolio companies. It's time to sell them, but they love the portfolio companies. They fixed the management. They've done multiple acquisitions, but there's more to do, and they can make another 2 to 3x return on those portfolio companies. So, you know, the market is about 50 today. It's about 50% GP-led deal flow, whereas you know, GPs are, you know, bringing strip sales, tender offers, single asset secondaries to the secondary market, and half limited partnership interests of, you know, institutional investors and high net worth individuals selling the limited partnership stakes. You can see we've put out about the same amount of capital in both categories, plus or minus $3 billion in each. But we've done, you know, about twice the number of deals on the LP side than that on the GP-led side. On the GP-led side, every time we've done one of these transactions, it's typically plus or minus 6 portfolio companies, and we've generated about a 36% IRR and a 1.7x cash-on-cash multiple. What's notable about the GP-led transactions is that about $1.5 billion of that $2.9 billion has been put out over the last 12 months. So, and I can tell you from having underwritten with the team all of those deals, much of that is still held at cost. So, you know, we've generated about a 36% IRR and a 1.7x multiple, but about $1.5 billion of that $2.9 billion is still held at cost. And so our expectation is that on the GP-led side, because of the high quality GPs bringing these opportunities to the marketplace, and because of the fact that about $1.5 billion is still held at cost, we think that the ultimate return on the GP-led side of our portfolio will typically be 2 to 2.5x, and the IRR will stay in the 25 to 30% range. On the LP side, they typically, you know, we're typically buying 2.5 funds per transaction. Each fund will typically have 8 to 10 portfolio companies. So you're talking about, you know, 16 to 20 companies in every transaction that we've done on the LP side. So a little bit more diversified. Our returns on that side have been 21% and 1.8x. And those returns are also appreciating quite nicely as well. So we expect the ultimate multiple on the LP side to also be significantly above where it is today. Next slide. I'll just spend 1 minute on this, but you know, this is kind of our formula, the grid system. We are looking for these 4 characteristics in everything we do, right? We want the opportunities to come from a GP directly, or if they are made aware of it after the fact, we want them to heavily influence it. And what that means is share more and better information with us, restrict the number of bidders that could possibly bid on that opportunity. And the vast majority of everything that we've done is GP directed. We typically like funds, as I mentioned earlier, that are ranked in the 1st or 2nd quartile. It doesn't mean that there's not an interesting opportunity in the 3rd quartile, but everyone in private markets knows that the 1st and 2nd quartile managers have about an 80% probability of continuing to perform in that quartile. And so we really do favor as much as possible 1st and 2nd quartile ranked fund managers when we can. We're always looking for an information advantage, and I would say we typically have a significant information advantage over any seller because, frankly, we just have a larger team that spends more time digging down and into the granularity of not just an individual fund, but all the underlying portfolio companies, and we're doing a massive amount of reporting on a quarterly basis to inform our clients how well their funds and their underlying portfolio companies are doing. And then, of course, we're always looking for discount. As I mentioned, we've been able to achieve about a 20% discount since the inception of our program. So those are the 4 ingredients that we look for, and you can see examples of those characteristics with the check marks. We're typically getting 3, if not all 4 of those characteristics in every one of the transactions that we're looking at. Next slide. So quickly on Fund 4, 84%, 1st and 2nd. This is our most recent secondary funds, which was capitalized at about $2.1 billion. Vast majority was first and second quartile funds that we purchased on behalf of our investors. The top 25 portfolio companies had a revenue growth rate of 6% and an EBITDA growth rate of 32%. Very low leverage at 3.8x EBITDA and a 0% loss ratio. So very, very healthy metrics on our most recent fund. And if you go to the next slide, again, 95% of everything that we purchased in our last fund was either a transaction focused on one or two sponsors. So if it's one sponsor, it might be two funds managed by a single GP, or it might be four funds managed by two GPs, but it's very much focused, rifle shot focused on the highest quality assets that we can possibly buy. Over 70% of everything that we purchased in our last fund was either small market growth equity or mid-market buyout. The average age of the underlying assets was 5.1 years, so still in the growth phase of the development of the underlying portfolio companies. And then 70 plus or minus funds represent about 80% of the net asset value. So diversified enough, but not over diversified. Next slide. Again, information. This is the slide that really talks about how much information we have. And you can see the third column there is the proprietary database. Our database simply is the best in the marketplace. It has more portfolio companies, underlying partnerships, GPs that are tracked in underlying portfolio companies, and more granular detail than any other database available in the marketplace. But an information advantage doesn't stop there. It's what is your global footprint? Do you have people in the local market that understand and have relationships with these underlying GPs? How frequently are you meeting with those GPs? Second column, do you have specialized teams internally that are focused on the small, mid-market, large market buyout, distressed, energy spectrum of the marketplace, so that you can focus, and react to an opportunity with specialized teams when an opportunity arises. And then last on the right there, statistical modeling and analysis. So we've got a massive amount of historical and projected information in our database. It's partly a result of how much diligence we're doing on an annual year and monitoring and reporting for our clients, but it's all the co-investment and secondary underwriting that we do as well. So we have a massive amount of information that effectively allows us to calculate how any one portfolio or any one portfolio company or a particular fund is likely to perform. And we've got a team of 35, it's actually 40 data science and engineering professionals that basically have built models that allow us to do top-down analysis, so that when we do fundamental analysis on a portfolio of funds, our top-down analytical tools will allow us to highlight areas where there may be additional value, or highlight areas where assumptions may be aggressive because of a particular manager's historical performance, or an industry that has more headwinds than we may have forecasted. So the analytical tools that we have from our data science and engineering team are extremely helpful in checking all the work that we do on a fundamental basis. So next slide. So this is how it all comes to life. This is a visual example of why we are more advantaged than all of our secondary competitors. The blue wedge here shows the amount of primary capital that we've given to this one manager called Providence Strategic Growth, or PSG. We've deployed, we're their largest investor by capital, by number of clients, and by the geographic footprint of those clients. So we've given this particular manager close to $3 billion of primary capital over the last 6 to 8 years. If you're their largest investor, right, they care like any other industry, they care very deeply about you, and they view you as a strategic partner. The dots here represent all of the secondary and co-investment opportunities that this particular manager has shown us over the years. So these are not opportunities that they're bringing everyone in the marketplace, and they're certainly not opportunities that are going through the auction segment of the market. This is us working in partnership with this manager on co-investment and secondary opportunities that come off of their platform. And so you can see that we've deployed, you know, over $100 million on the co-investment side and over $400 million on the secondary side. Again, because we're so large on a primary basis, it results in significant proprietary opportunities on a co-investment and secondary basis. The green dots just show you opportunities that we passed on with this particular manager for any particular reason. Next slide. Discounts, as I mentioned, you know, pricing is very high, particularly when there's 50 to 100 people bidding on any portfolio in the auction segment of the market. The blue line here just shows where product has typically sold in the auction segment of the market. So, and remember, this is all four quartiles. This is first, second, third, and fourth quartile funds being, you know, priced as an entire body. Those funds will typically trade anywhere from 85% of par to par. So 85 to 100 cents on the dollar. And you can see in the yellow line there, our blended price that we've paid over the last, you know, 13 years of our history. So we've achieved, you know, an 80% price or a 20% discount on everything that we've purchased. And if you include all of our prior funds, 70% of everything that we've purchased is either a first or second quartile fund. So the blue line basically shows the market pricing for all four quartiles, right? People buying first, second, third, and fourth quartile funds. And our line shows what we paid for higher quality concentrated on the first and second quartile funds. Next slide. So, you know, this is an example of different types of transactions that we've done. Cinven is a you know, acquisition of two funds, a very, very high performing pan-European manager. Our diligence team in Europe knows them extremely well, knows their underlying portfolio. They were very passionate about the opportunity. I believe we paid, I'm going to go off memory, I believe we paid par for this portfolio. It closed in November of 2020, but the team had a lot of conviction. This transaction is already at a 1.6x ROI. So this is the power of giving a high price optically when you have a European team that really knows the underlying assets and can show you as a decision maker where the value is going to come from and have confidence in that. You can lean into opportunities and pay an optically high price to the seller and get it approved through their system, but at the same time capture a massive, you know, information arbitrage and therefore value arbitrage for your underlying investors. So we do this all the time. It doesn't matter whether the price is 90 cents on the dollar or par or even 102 or 105. If we know there's significant value that is not reflected in the current information or the current financial report, we will lean into these opportunities. And so you don't necessarily need to get the price or the discount as of record date, but it's always nice to get it as of the point that you close, because when you bid off of a particular fund or a portfolio, sometimes you're bidding off a financial statement that's 6 months old, and there may be one or possibly two financial statements that either were recently released or are about to be released. And so the magic is not what you paid relative to par, not or record date. The magic is what you ultimately paid at the time of closing and how that portfolio performs post-close. But all of these transactions, whether it's, you know, Project Balfour, where we bought 23 high-quality small, mid-market, and large buyout funds, that's an example of buying a portfolio at an alpha return. That particular portfolio is priced to a return of about 1.8x. Typically, multi-fund portfolios are priced to a return of about 1.3 or 1.4x. So it's an example of, with more and better information, we can isolate very high quality portfolios and get them at an attractive price, which, you know, implies an above market return. And then on the right hand side, you know, Project Camp and Project Moby are two examples of particular managers coming to us and creating bespoke opportunities in a closed process as opposed to an auction segment of the market. These best in quality GPs, when they are doing something with their portfolio, either selling a strip to manage up their distributions or helping them warehouse underlying assets, they're going to call a strategic partner who's very important to them on the primary side. And these type of transactions don't typically go through the traditional auction segment of the market. And by virtue of how much capital we manage on behalf of our investors, the best in class managers are typically bringing those opportunities to us. Next slide. So I think I'll end on this slide. There's more, materials in the presentation, but I want to leave some time for questions if there are any. But these are our returns. We've had 4 different fund series, 1 through 4. If you look under, Fund 4, as I mentioned, that was a $2.1 billion fund, but you can see our total capitalization was $4 billion for Fund 4. So it's about 2.1 of commingled capital in conjunction with about 1.9 billion of separately managed account capital. But our program has grown quite nicely since Fund 1, right? We started out with approximately $600 million of total committed capital, and Fund 4, most recently, $4 billion. This new Fund 5 that we're in the marketplace right now will probably be $3.5 billion of co-investment capital, commingled capital, and then about $1 billion to $2 billion of separately managed account capital that invests side by side and pari passu along with the main fund. But from a returns perspective, you can see our more mature funds, Funds 1 and Funds 2, have generated gross returns in the 1.9 to 1.8x range. But the net cash multiple, because there's so much cash that come off in the early years of these funds, that you actually don't need to pay in all of your capital commitments. So if you commit $1 million, you're typically only paying in $500,000 or $600,000. And so, but you get the advantage of, having $1 million of exposure ultimately. But because of the self-funding nature, when liquidity comes off the portfolio, instead of calling investors capital, we will self-fund any capital calls that come off the portfolio. So that's why the net cash multiple is higher than the gross multiple. But our investors on our earlier, more mature funds have generated a 2x net multiple on their commitments. And then our more recent funds, Funds 3 and Funds 4, are in the 1.6 to 1.8 range and still significant and still growing at a significant rate. Our net returns are, range from 15 to 20% from Funds, 1 through 3, and 70% in Fund 4. Simply reflective of the fact that there's a lot of initial discount that are showing up in our IRR, but that will erode over time, and the IRR should balance out in the 20% to 25% range ultimately. But very, very good, blended performance, 20% net, 1.8x net cash multiple without the use of leverage. I would say, based on all the, information that we've seen from our competitors, these are market-leading returns on their own. But when you consider the fact that we haven't used leverage to enhance our returns, I would describe them as higher returns on a risk-adjusted basis. So with that, I will end it there, but maybe just stop, if we could, for a second on slide 23, because I know that we do have some investors that are with us in Fund 4. I just wanted to let everyone know that the assets in Fund 4 are performing extremely, extremely well, right? I mean, this is a reflection of the market going our way, but also the high quality underlying assets that we put into this particular fund. But it's also reflective of the proprietary deal flow that we're seeing from the managers, and particularly this new wave of GP-directed deal flow. These are very good GPs offering single asset and multi-asset continuation vehicles, some of their best portfolio companies that are growing at a very high rate of return. So this just shows in green bars here our quarterly return on our most recent fund. But, from quarter to quarter, typically a good quarter for anybody's, private markets portfolio is 2.5%, because if private equity does 10% per annum annually, on an uncompounded basis, that's 2.5 percentage points of gain per quarter. That's a great quarter. Our quarters have been 8, 10, 20, or even 40%. And it's been fairly consistent dating back to the first quarter since we activated this fund. This is an extremely, extremely high performing fund that has already generated a 1.7x gross return in a little over 2 years. It's kind of unheard of, but it reflects the quality of our proprietary pipeline, the quality of the GP deal flow that we're seeing, the skill set of the broader team that I'm a part of. And we are so thrilled that our investors are the beneficiaries of this type of exposure. And we have very, very high expectations for the ultimate performance of this fund. So Fund 3 has a similar profile. I think this fund was up 60% year over year. I think Fund 3 is up 40% year over year. And then Funds 2 and Fund 1 are much more modest in terms of their year over year performance, but simply because they have typically gone through the majority of their realization phase. So I'll leave it there and just thank everyone for their time. For those of you who have already invested with us, thank you for your support. We hope that you're pleased, and we hope that you will join us in the journey on Fund 5. Shannon, back to you.
Thank you, Mark. Shannon, you want to get into?
No, go ahead. Go ahead.
Okay.
Jose Antonio.
Thank you, Mark, for your presentation, which was quite impressive, and congrats for all the you have shown us. We have a couple of questions from the attendees. The first one is a quick question regarding how much money do you manage in this study. You mentioned within these 4 funds, you have almost 8.3 billion. So the question is, how much do you manage or advisory in SMA? That's a very quick question, maybe.
Yeah. So I think the best slide to go to is frankly the slide
21. Slide 21.
Slide 1 is probably the best, Shannon, right? Yeah. Slide 5. You mean they're asking as a platform, right?
Yeah, so the difference between funds and SMA, you mentioned before that you invest across all the different strategy, and so the question we received from the audience is how much money do you get from the SMA, and in some way trying to understand how important or significant is funds in the strategy. Oh,
right. Yeah, so the simple answer is in Fund 4, on the secondary side alone, the commingled fund is our largest and most important investor base. It represented 2.1 billion of the $4 billion in that Fund 4 series. And so we have about 1.9 billion of separately managed account capital that sits side by side that $2.1 billion commingled program. And then, I don't know if this was also part of the question, but as a firm, we're managing or overseeing close to $500 billion of total capital, but the discretionary capital that we have under management is about 110 billion. And then in Fund 5, again, getting back to the secondary only, Fund 5 should be about $3.5 billion of commingled capital, and then $1 to $2 billion of separately managed account capital that will invest side by side. So those conversations of, we won't know how big Fund 4 series will be until we speak with all investors, whether they want to re-up with us. But the commingled fund, because we've already set a target, will be 3.5 billion or larger. But in recent years, our separately managed account capital that has invested side by side with all of our commingled vehicles is somewhere in the range of $1 billion to $2 billion. So if I had to guess what Fund 5 will look like, it's probably going to be, 3.5 billion of commingled capital, and $2 billion of separately managed account capital.
Good. Thanks, Mark.
So we will have gone from 4 billion to 5.5 billion.
Sure. Great. Thanks, Mark. Another question regarding the discount. You mentioned one is a key point in the strategy, and you compare on average this 20% of discount. A couple of questions regarding that point. When you mention this 20% discount, is comparing what the value is at the time of the deal is closed or at the end of the strategy, saying that you compare with the market that is almost within like a 5%, something like that. So if we want to know if the discount is the same, period of time when you can make this comparison, and the difference between the GP lead transactions and the other ones, if there are any difference in terms of the discount, and in that regard, how the incentives are getting involved in this, different gap in discount, if there is one.
Yeah, great. Okay. So it's a very, very good question. So I would ask you to go to slide 54 in this presentation. So the question is, what is it discount to? Is it discount to record date? Is it discount to, ultimate performance, or what is it? But this graphic, and we show this to all of our investors, okay? On page 54, 55, 56, and 57, and 58. This is every transaction that we've ever done since inception, and the three rightmost columns show the discount to the record date NAV published by the GP. The second column reflects the discount to the GP NAV that was published just prior to when we closed. And then the rightmost column shows the discount to the GP published NAV after we close. And so there's a lot of confusion in our marketplace because people put discount numbers in their presentations and limited partners don't know what that means. Here we show you discounts to every metric that is out there. Record date, pre-close NAV, post-close NAV. I would submit to you that the most important one is the rightmost column because you own it at that point, or we own it on your behalf at that point. So if you go to the last page, 58, on the bottom right, see the weighted average, the average, and the median, right? We've achieved, if you take a weighted average of 13 to 17% discount, regardless of what metric you choose. If you take the average, it's 18 to 25% discount, and if you take the median, it's 12 to 22%, right? And that's why we say, generally speaking, it's about a 20% discount that we've achieved since inception. Now, discount matters because you get a significant portion of your total return from discount. And if you look through this chart, you can see that we've actually achieved a significant discount no matter what metric you use and no matter what date of GP NAV that you focus on.
Great.
But what's also very important is the growth of the underlying assets. So if you buy a fourth quartile fund manager at a 30% discount, you're going to feel really good at close. But in 3 years, when nothing's been liquidated and the portfolio valuation has contracted because they've lost team members and they're not generating carry and they can't raise a successor fund, there's no glory in that. So the trick in secondaries is getting large discounts on very stable, high quality funds and underlying portfolio companies. And so, we typically will get a third of our total return from discount, and then probably 2/3 of the total return from value add at the portfolio company level and at the GP level, meaning the value that they add to expanding the underlying value of the portfolio companies held within each fund.
Great, thanks, Mark. Another question regarding leverage. You pointed out that this comparison between Stepstones and other fellows there, and you mentioned that Stepstone doesn't use leverage. So do you know how much of their returns for those competitors is provided by this leverage, and how significant is in terms of return the use of this leverage for the competitors?
Yeah, so it ultimately, at the end of a life of a partnership, it can add 400 to 500 basis points to the total the IRR that you generate. So if you took the same two portfolios, one levered and one unlevered, right, and the unlevered generated a 20% return, you would probably generate about a 24 or 25% return if you invested in the levered version of that strategy. But early in the life of a fund, the delta between levered and unlevered returns is magnified. So if you're buying assets at a 3, 5, 7, or 10% discount, and you're using leverage, you're putting up less money up front, so the total gain is magnified. And so early in the life of the portfolio, it can be, 1, 3, 5, 7,000 basis points that's added to the total return in terms of of levered versus unlevered. So it's about 400 to 500 basis points ultimately. It can be, it can be 30 to 60 percentage points early in the life of a fund or more. So I would caution investors, don't look at short-term returns. Like even our returns on our fund 5, the IRR doesn't matter, but the multiple certainly does, right? The multiple you should look at, and we're at 1.7x multiple of money right now. We've generated a 70% IRR, but the IRR is only 2 years old. And the portfolio is not growing at 70% per annum. It grew at 60% over the last 12 months, and that's a good thing, but it's not going to grow at 60% for the next 3 or 5 years.
Yes, sure.
And so hopefully it'll grow at 20% though. So if you geometrically link 70% IRR today with 4 or 5 years growing at 20%, the IRR is going to moderate. So I would encourage you, all the investors on the phone, look at discount, ask for this information, look at mature IRRs. What are they really generating? Don't get seduced by, a fund manager's returns that are 1, 2, 3 years old. Get seduced by the quality of the portfolio, get seduced by the discounts that they're achieving, get persuaded by the ultimate net returns, the mature net returns, and ignore everything else. There was a question about the GP-led returns having a discount. I just wanted to go back to that. Typically limited partner portfolios will have a larger discount. And they start, if you look at the J curve of a LP portfolio purchase, you might start at a 50, 60, 70% IRR because you're reflecting a 10 or 15 or 20% discount. And the portfolio that you've purchased is 1 month old or 2 quarters old or whatever it might be. So your IRR tends to start very high, but as that portfolio generates returns quarter over quarter, that high IRR gets weighed down by the successive periods of lower returns. In the case of GP, so it's basically a negatively sloped J curve. In the case of GP directed deals, those are typically sold at 95 to par. And so you don't get that IRR sugar high or initial discount typically. But what you do get is very strong underlying portfolio growth. So you get almost immediately the portfolio growing at 10, 20, 30% per quarter or per year. So the J curve on the GP directed side is a positively sloped J curve from an IRR perspective. At some point, the negative sloped LP purchase intersects with the positively sloped GP directed purchase. Ultimately, we can achieve a higher multiple of capital, and I believe a higher IRR on the GP directed deals, because those are typically funds and underlying portfolio companies that are growing at a higher rate than a random mid-market or lower mid-market fund that has companies that are of high quality and maybe a couple others that are weighing down that portfolio. So you typically have the tale of two worlds where those two J curves intersect. With the GP directed, even though you don't get an initial discount, you are performing or expected to perform better than the LP portfolio, which typically, performs slightly lower than that.
Thanks, Mark. We have, I think, two questions to go. The first one is regarding your investment in the Fund 4. If you have thoughts on selling part of it, just to try to lock the gains on that fund, and if you can elaborate on that, thank you.
Yeah, so that's a very good question. So we've always told our investors, we very strongly believe that a lot of people are in our industry to gather assets, and we are not interested in that. We view ourselves as an investment manager, not as an asset gatherer. So when we raised Funds 1 and Funds 2, we made a promise to our limited partners. Our intention is to hold this portfolio for as long as it takes to achieve the objective of generating above market returns for you. And once we've achieved that goal, we will sell the remainder of the portfolio instead of keeping you around having to monitor this portfolio in years 11, 12, 13, 14, 15, 20. And so we just went through a process that has about 70% of it is closed and will be closed by the fourth quarter. We've sold about $500 million worth of assets in Funds 1 and Funds 2. But Funds 4, it's not really the right time to sell Fund 4 because there's so much growth that's still available in Fund 4. And so we will let Fund 4 play out for a few more years, but we will do the same thing, and we will reap the benefits and take the liquidity as these managers liquidate these underlying portfolio companies, and we will get paid handsomely and return that money to our investors. But for the stub piece that is sticking around in years, 8, 9, 10, we probably will look, and as I mentioned, I expect Fund 4 to be a very, very strong performer. We will probably start looking at selling Funds 4 in years 8, 9, and 10. But we never want to be an administrative nightmare or burden to any of our investors. Our job is to invest it wisely, to liquidate the portfolio and return capital and shut the fund down over a reasonable amount of time.
Thank you, Mark. Just one final question. We are on time. The question from the audience is if you have public market equivalent returns for the previous funds?
I don't know if we have the PME calculations, but Shannon and I will check with our due diligence team. It may already be on the data site, but if it's not, we can post it there. I don't know who specifically asked that question, but if you can find out from the group, or if that person can specifically reach out to you or to Shannon, we'd be happy to calculate it and send it to them specifically. But we should check to see if it's on our data site first already.
Great, thank you, Mark. So guys, thank you very much.
There is one other question that I think is a good one.
Sorry, I didn't see. Okay.
Someone's asking actually which type of leverage forms are used in secondaries. Can you comment on that? What types of?
Yeah, so the types of leverage that secondary managers use are, they'll use asset level leverage, meaning they'll buy a $1 billion portfolio, put it into an SPV. It's kind of off balance sheet financing. They'll buy a $1 billion portfolio, put it into an SPV, take a loan out based on the value of that portfolio of, call it 50%, use the proceeds of that loan to pay for half the portfolio, and then use equity capital from the fund to pay for the other half. But you never see it in the financial statement. You just see, the fund owns a stake in this XYZ partnership. And so you're blind as an investor, you're blind to it. And so that's a lot of leverage. So if you're talking about a portfolio that's levered at 50%, if it's up 5% for the quarter and they use 50% leverage, as an equity investor, you're going to be up 10%. But if it's down 10% for the quarter with 50% leverage, you as an equity investor are going to be down 20%. All of that is kind of behind the curtain. You don't really see that. And that's why volatility of returns can be impacted by asset level off balance sheet financing. The second form of leverage that people use is the capital call facilities. They will maximize their capital call facilities. Some managers will raise a fund and not call capital from investors for 2.5 years. It's odd, but you'll get a positive capital account balance and you haven't paid any capital into the fund whatsoever. And secondary managers will use their capital call facility for as long as they can keep it out and push it as high as they possibly can to generate, again, this sugar high of high returns that ultimately erode. They're creating a financial return oasis for all investors to march to ultimately and commit to their next fund. And then the third type of leverage that managers use is they may agree to buy $1 billion portfolio and they might get seller financing. They'll say, listen, I'll pay you par for your portfolio, but I'm going to pay 60% now, 30% in 12 months, and 10% in 2 years. Delayed payments effectively. And so there's really 3 different forms of leverage, and you've really got to ask your underlying GP which forms of leverage they actually are using, how much their returns are enhanced by the leverage. And frankly, you should always ask for gross unlevered returns at the portfolio level so that you can actually see the impact of leverage on your ultimate return.
Thank you, Mark and Shannon. I think, guys, we're almost there. And so I want to thank you for being with us this afternoon. And thank you for all the attendees and the audience in this webinar. As usual, we in the BICE team will be at your disposal for any further questions. So thank you very much, Mark, Shannon, for being with us today. Muchas gracias a todos por acompañarnos. Cualquier pregunta, por supuesto, a su disposición para poder responderla. Esperamos vernos prontamente, ojalá en persona en algunas próximas semanas. So thank you very much, guys. Mark, Shannon, thank you, guys.
Thank you, guys. Thank you, everyone.
Thank you. Gracias.
Bye, everyone.